Hey everyone, in 25 years, your money is likely to be worth half of what it is today. Today we're going back to basics and explaining why it is imperative, it is a must, that you invest your money. Imagine you wake up 25 years from today and everything costs twice as much. You know what? That's the exact reality that all of us are likely going to face. And that's why it's so important to invest your money. It's not a nice to have, it's not a maybe, shoulda, woulda, coulda, kinda, sorta, if you can kind of thing. Because yeah, if you don't invest your money, if you put it under a mattress, if you put it in a checking or savings account with some low sub 1% interest rate, you are guaranteed to lose money over time. The value of your money will go down with the rate of inflation. Now, in the world of finance, there's a really cool rule called the rule of 72 that will tell you for a given interest rate how long it will take for your money's value to double, or conversely, how long will it take for your money's value to be cut in half. At 3% inflation, your cost of living will double in roughly 25 years. Conversely, at 7%, your investment will double in 10 years. Divide 72 by the rate of return to find out how many years it will take for that amount to double. Or in the case of a negative return or inflation, how long it will take for the amount to be cut in half. What you do is take the number 72 and divide it by the interest rate. So if you were to assume that we're going to average 3% inflation, well, you can take 72, divide that by 3, and you get 24 years. That's where I got this idea that in approximately 25 years, the value of your money will be cut in half. Now, conversely, we can also use the rule of 72 to determine how long it'll take for your money to double in value. To start with, we'll have to make an assumption about the rate of return you expect your investments to make over time. A nice conservative estimate for equity index funds would be 7%. So if we take the number 72 and divide that by 7, we get just over 10 years. So if you had a chunk of money and invested it at a 7% rate of return, you can expect that chunk of money to double in value within 10 years. But it's not quite that simple either, because remember that we assumed that we're going to have an inflation rate of 3%. So if our money grows at 7%, but inflation's growing at 3%, well, the real amount of return we're getting is 4%. 7 minus 3, 4%. So let's take 72 and divide that by 4 to determine how long it'll be before your money truly doubles in real value. In other words, how long will it take for it to really buy twice as much as it does today? So using the rule of 72, we can determine how long it would take your chunk of money to double in value using a 4% rate of return. 72 divided by 4 is 18 years. So that would mean if you get a 7% return on your investments and inflation is 3%, your net return is 4%, and you can expect your money to double in value every 18 years. So if we expect our money to be worth half as much in 25 years, well, if by investing it at 7%, it's going to become twice as valuable in only 18 years. So you've got that kind of difference in there, 18 versus 24. And in this case, just by investing at a 7% rate of return, you are keeping up and just slightly beating the rate of inflation. You know, if your investments can't manage to keep up with the rate of inflation, they're going to lose value. I mean, I don't know, let's do the math. Maybe all your money is in a high yield savings account earning 1% a year. Well, that's pretty good as far as savings accounts go, but if inflation is 2 or 3%, you're not keeping up. And it's only a matter of time, even if it's decades away, before the value of your money is cut in half. And so this is the reason that investing is not optional. You have to invest to keep up with the rate of inflation. There's not another way to do it. You can't park your money into a savings or checking account and expect it to keep up with the rate of inflation. It's going to lose value. It may happen slow enough that you really don't notice it. It's kind of like the frog in a pot of hot water. You turn up the heat slowly enough, the frog doesn't realize that it's getting hotter and hotter in that water. And by the time the water reaches boiling, the frog doesn't even realize it. It's too late. Don't be like that frog. You have to invest your money. Investing your money doesn't have to be complicated at all. Yeah, the stock market can be volatile. Yeah, that is scary. It's hard to watch your hard-earned money go up and down in value like a roller coaster. It would be really ideal if the market just went up at a steady clip. So if you were to say, I'm going to make 7% on my investments, and it's just going to be a straight line, 7% straight up, Unfortunately, that's not how it works. It's a bumpy ride. It goes up and down and up and down. Some years you may make 20%, some years you may lose 20%. It can be tough to stomach that. But over time, the investment is all but guaranteed to beat inflation, and that's the important part. You must beat inflation if you want to get ahead. Unless you're a professional athlete and you're going to sign some multi-million-dollar deal, it's the only way to get ahead. It's the only way to make your money grow. It's the only way to build wealth. The rule of 72 helps us think long-term because it's all about long-term thinking versus short-term thinking. If you're thinking short-term, you're looking for the quick win, the speculation, the gamble, the GameStop stock. That's all short-term thinking. And maybe it's fun. It may be fun to think about and fun to speculate and fun to gamble on, but it's not a strategy to build wealth over time. It's not a strategy to keep your money gaining momentum and staying in front of inflation. I know what it's like to get started with very little and feel frustrated about the pace of progress. You want to see that account grow faster than it is. The thing is, it takes time. You need to start where you are, start small, and start the ball rolling. Let it gain momentum and pick up speed, and before you know it, it is going to be a giant boulder, a giant out of control wealth building boulder. Be patient and build wealth slowly. It's the only guaranteed way to build wealth. Patience, patience. You just need patience. Stop speculating, stop gambling, and start investing. Invest your money. I invest mine mostly in low-cost index funds that mimic the return of the US equity market. You could also mix it up, put some into international, maybe some into bonds. If you don't want if you don't want that line to get too bumpy, you want to straighten it out a little bit, well, you can add some bonds to your portfolio. That'll help straighten that line a little bit. But there's really no way around the fact that the stock market is volatile. There's going to be ups, there's going to be downs. It's just part of the process. And if you put in money into the market over time consistently, you're going to invest sometimes when the market's low, sometimes when it's high, and you're going to average out quite nicely. You don't have to worry about getting the timing right. It's not about timing the market, it's about time in the market. Real investing takes time. It's not going to happen overnight or within a week or within a month. It's an ongoing process over the years, over the decades. And it works. It works. You've got to get that ball rolling. I know it's hard to be patient about your returns. You want to see big gains quickly. You want to see that number in your account go up quickly. The bottom line is that's just not how it works. Start today, contribute regularly, let compound interest work its magic. And remember, inflation is right behind us, nipping at our heels, trying to drag us down, and we're going to stay ahead. We're going to stay ahead of inflation. You can do this. You can beat inflation. You can stay ahead of it with a modest 7% return. Anything above the rate of inflation will do. But if you really want to build real wealth, you're going to need to invest in the stock market. If you're a short-term thinker, it's probably really hard to be patient. But you have to retrain your mind because, let me tell you, the only guaranteed path to wealth is the slow train, not the bullet train. The bullet train is sleek and sexy, but it's unsafe. It's probably going to crash before you ever get close to your goal. On the other hand, the slow train chugs along day after day, week after week, month after month. No one thinks it's sexy at all. No one thinks it's cool, but what it is safe and steady, and it's going to get you there. And it will get you to your goal. That's what I have for you today. Just a quick back to basics video. After the crazy week we had last week with GameStop and all that, I thought it would be great to go back to the basics, learn about the rule of 72 and why you must invest your money. Thanks for watching. Remember to like and subscribe. And it's almost a certainty that the slow train will get you to your goal. All right, enough of this nonsense.